Good afternoon, everyone. January 31st, wild day in the market. But I wanted to talk about a couple quick things. Most importantly, how to do straddles when trading options, and how to protect your trades, and almost in some cases minimize your loss. And I don't want to say guarantee a winning trade, but increase your chances dramatically when you have major catalysts and volatility in the market on certain days. So for example, a day like today, we have an FOMC meeting coming up at 2 o'clock. Now, it's not guaranteed that the market's going to go wild at 2 o'clock, but the chances are likely. It does happen. It's a major catalyst, and usually will move the market significantly in one direction or the other. So when we come across these situations, it's a terrible idea to just trade. Well, you shouldn't be trading those situations at all unless you're doing a straddle. And the reason why is because you're kind of gambling a little bit with a regular trade. If it goes in your favor, let's say you buy some calls and the market explodes at 2 o'clock on an FOMC day, of course you're going to make a very nice amount of money on that trade. But if it goes in the other direction, you're going to lose your options premium, and it's most likely not going to recover, and you're going to take a loss. But what if I told you there's a way that you can do it, that you minimize your loss and significantly increase your chances of winning the trade? The trade-off is you're not going to make as much on the trade, but it's called a straddle. So basically what you're doing, and I do this in most of my trades, whenever a lot of people like to trade the earnings calls. They wait, for the after hours, big moves on earnings calls. This call, you have to learn how to do straddles if you want to trade this stuff successfully. You could almost win these trades every single time if you know how to do straddles. And if you do lose the trade, it's going to be a much, much smaller loss, well within your threshold. And when you learn to do this, I'm telling you, it's phenomenal. So, for example, what a straddle basically means is you're buying both ends of the trade. So you're buying a call and a put for the same stock, but we're using different strike prices. So typically what I like to do is, let's say, for example, I have a straddle right now in the IWM, Russell 2000 Index ETF. And that is for today, today trade. 2 o'clock is coming up, FOMC meeting. So I bought a 197 call. The stock price is around 196, so 196, you want to be right at the money. And then I bought a put at 199. So if the market moves up $10, which, so the last 3 earnings calls, the IWM moved $10 in one direction or the other. So if it goes up $10, I'm going to make money. If it goes down $10, I'm going to make money. The only way I can't make money is if it stays flat. So that's what a straddle does. You have a window where the stock has to move out of that window, and it can be in either direction. So, you can go to options profitcalculator.com, and you can actually calculate the exact amount, with options. If you're not using optionsprofitcalculator.com, you're missing out on a very simple tool to really map out what your options trades could potentially look like. You can plug in all the numbers and it'll give you a big grid showing your profit and loss depending on where the stock price goes and the volatility. So that's what you do. You're buying a call in one direction and then an in-the-money put going in the other direction. Both of them should be at the money or in the money. I like to do the put slightly above on with the strike price. That's just my cup of tea. You can put different numbers into the grids on optionscalculator.com, optionsprofitcalculator.com, sorry, and you can figure out these numbers. But when you do this, whenever you have times of volatility, which is basically every earnings call for any stock with any sort of volume, and FOMC meetings, which happen multiple times a year, plus you have CPI, PPI, and all the other economic data that comes out. These are times of almost, I don't want to say guaranteed volatility, but very, very close, and you're going to get major movement. And in most of these cases, I would say, in my opinion, 70% of the time, probably higher, you will get enough movement to make a little bit of a profit. It just matters how much you invest. So again, look into straddles. If you have any questions, feel free to ask. But this is the most important thing that you need to learn as a trader. I mean, we can day trade every day and have great trades, but if you don't know how to do straddles, you're missing out on money. It's I don't want to say anything's easy money or guaranteed, because it's not, but this is a significant strategy and to have in your arsenal as a trader. I do very well with straddles throughout the year, and I've made really good money doing them. And you don't have to worry when you're trading. It's all you're looking for is a big move. So you don't have to be sitting there scared, you know, if you bought calls and then you see a big red candle, oh my God, I just lost huge. That's too much anxiety. That's nuts. You can do this in a comfortable way. So any earnings call that's coming up, you can map out a strategy to do a straddle and buy calls and puts, and you can just, and all you're waiting for is it to explode in one direction or the other. It's you don't have to worry about which direction it's going. You just want volatility. And when you learn this, it is really just, it's the best thing I ever learned. So I have to share it. But again, if you have any questions, feel free to drop it in the comments. Be happy to help you out. It's very easy to learn, and you know, start out paper trading it. You know, practicing. When you start doing with real money, just start out small. You know, 1 or 2 contracts. You know, nothing crazy, just to see how it works. But when you learn, this is going to be big for anyone that gets involved in it. So appreciate it. Like and follow. Take care.